Hello everyone, welcome to the K Johnson G, Helping You Build a Better Business webinar series. We are having a look at a number of corporate finance related topics in these, and today we are having a look at the management buyout or MBO route map, and a guide hopefully to how a management buyout or a related deal, management buy-in, or potentially employee-backed buyout or EBO may be achieved. This diagram, I'll just move my face out of the way. There we are. This diagram gives an indication of broadly how the management buyout or MBO should be looked at in its structuring and execution. The areas to look at are deal structure, the financial aspects, valuations and forecasting, the funding of the deal, and by considering all of these and how they relate, because they are related, needless to say, we will get an indication of broadly how an MBO typically will be structured. So the first thing to consider are the financials. We tend to pay some attention to the numbers because they tend to drive the MBO terms and structure. On the financials, the key thing that we have to pay attention to and evaluate is maintainable profit. What we're trying to understand is not what recent profits have been, not what we expect the profits will be in some high-level way, but actually to understand a maintainable level of profitability for the business that takes out any non-recurring one-off items or exceptional items that have taken place. Now, some advisors are prone to throwing the kitchen sink into this evaluation and treating things like normal levels of bad debts, for example, as being exceptional or non-recurring, which of course they're not. They're a normal part of running a business, sadly. But whatever we look at, however we look at it, we come up with a view of the profitability on a maintainable basis of the business. The second financial aspect to consider are the net assets of the business on the balance sheet, and here we should be looking at the balance sheet, as I say, but also whether there are values in those assets not reflected in the accounts. Typically, that would be classic area. Would be as regards land and buildings, where historic prices paid may be reflected in the accounts rather than more recent valuations. So we should consider a true net asset position for the business. As part of that, we should also consider surplus, whether there are any surplus assets. The normal area where that may apply or item that may relate to is surplus cash. It is not unusual for a business to have retained cash, which in reality the business does not need for its operations. And if that is the case, then any surplus assets like that cash or a property that the business doesn't need, or a yacht that's berthed somewhere that the business doesn't need, those sort of surplus assets not needed for the running of the business need to be added to the evaluation of the business that is driven by maintainable profits and realistic net assets. So all those financials will feed into valuation and forecasting. Deal structure, over on the right-hand side, splits into three major areas. Here we should consider what the shareholding position, the vendor's position, and the NewCo element of it. Running through those in turn, the shareholdings need to be looked at as regards both the existing position as regards the current shareholders in the business, and the new funds element of that is considering from an MBO point of view, looking at the management in the business who are buying the business, what levels of funds can they bring to the party. The vendor, the potential seller of the business to the management team under the MBO, then needs to consider the extent to which they are willing to take deferred consideration over a period of time, and as part of that, or in addition to it, or in its entirety, whether that could be structured as an earn-out based on the future performance of the business. The vendor also, secondly, has to consider whether they are at all interested in a rollover of some of their shareholding, because they can, of course, retain a shareholding in the new regime, which makes the deal easier to fund and may actually suit everyone because of a continued involvement from a shareholding point of view, at least on the part of the potential vendor. NewCo, third element of deal structure, relates to the fact that a management buyout or MBO will be structured by introducing a new company to put in place above an off-the-shelf company, normally, to be put above the existing company or companies to undertake the deal from a legal structuring point of view. So financials and deal structure feed into a consideration of the value that can be put on the business, and the a key driver of that, the forecasts that are reasonable forecasts for the business that will drive the valuation that should be used in structuring the deal. Once that value is agreed, we'll then move on to the area of funding. Now, one of the key things to mention here is to dismiss the misnomer, which is sometimes on a good number of occasions mentioned by business owners, where they say something along the lines of, how can I sell to management? They don't have the money. Of course, management don't need to actually personally have the money. The funding for the deal is provided from a number of sources, which we will run through in just a moment. But before moving to that, on the right-hand side at the bottom here, we have the uses of the funding. So what is the money for that we're looking to raise to execute the MBO? First, of course, is the consideration payable to the vendor. The second is the costs of doing the deal, and of course there are there's tax to pay, like stamp duty on the transaction, and advisors tend to want fees for their expert input. They tend not to work free of charge. Third area of funding requirement may be development capital. So as we look at the business and its forecasts, it may be thought that actually there is an opportunity to introduce funding which will be used by the business, not by the vendor, not taken by the vendor, but used by the business to execute its plans. Fourth area of use of funds is obviously working capital. So this is, as you will know, the normal day-to-day funding requirement of the business. And finally, not least of all, the final use of funds is obviously the net debt position of the business as it is acquired. If the business has an existing level of net debt, net of cash, this is interest bearing, external debt like bank debt, invoice discounting, etc., that existing level of net debt needs to be dealt with as part of the transaction and either refinanced or rolled over into the new regime. So once we have a view of the funding that is required, we then come on to where we get the funding from, namely the sources of the funding. As mentioned earlier, the MBO team have normally got an ability to introduce some level of funding to the deal. This is not meant to be the core of the funding, because most people don't tend to have bags of cash sloshing around in their basements waiting for an MBO that they're taking part in. But what we're looking for here is a level of cash, which is a level of funds that the management team can introduce, which on the one hand incentivizes them to be totally committed to the deal once it has taken place, but on the other hand doesn't traumatize them so much because they've financially geared themselves so much personally that they are traumatized on a day-to-day basis and can't operate the business. Best description I've heard of this is it's an amount of MBO team funding which gets the management team out of bed early in the morning to go and operate and run the business, but isn't an amount that keeps them awake at night such that they can't sleep and get up in the morning to do that very thing. Second area of sources of funds we've touched on already, which is from the vendor. So the vendor can take deferred terms and or roll over a certain percentage of the value into the new entity, the new setup. Third source of funding is debt. So this can be bank debt, invoice discounting type debt, interest-bearing debt, which is, and in this area, there are many different types of providers and debt funders available. Fourth area where it's relevant is equity funding. Equity funding, as a broad rule, will only realistically be available if an equity funder believes that they can buy in to a deal at a certain level and within 3 or 5 years will be able to exit at a value of the business at a much higher level. In other words, there needs to be a strong growth possibility for the business for equity funding to be possible. The final source of funding, of course, can be the other side of the net debt position that we described earlier. Some businesses will have net cash in the business. In the same way that we described earlier, where surplus cash that sits in a business will increase its value, of course, that surplus cash is in the business, and of course, it can be used to actually fund that element of the deal and therefore nets out. So that's a quick run through of the various elements involved in a management buyout and the structuring of such a deal. They are complicated, but they are it's a well-trodden path, and as long as your advisors have experience of undertaking such deals, they are eminently achievable. Thank you very much for listening, and take care.